Imagine a thief silently siphoning money from your bank account bit by bit, day after day. You hardly notice at first, but over time, the losses accumulate, leaving your savings significantly depleted. This, my friends, is the insidious nature of inflation. It's a silent portfolio killer that every investor must be wary of. Inflation, in its simplest form, is the rate at which prices for goods and services rise over time. This means that the purchasing power of your money decreases. What you could buy for 100 rupees a year ago might cost you 105 rupees today. While this may seem insignificant in isolation, its impact compounds over time, eroding the value of your investments and savings. For long-term investors, understanding inflation is not just important, it's crucial. It's about ensuring your hard-earned money retains its value and continues to work for you, even as the economic landscape shifts. Ignore it at your own peril. Remember, in the world of investing, knowledge is power. By understanding the dynamics of inflation and its impact on the market, you can make informed decisions to protect and grow your wealth. Let's delve deeper into the intricacies of this silent threat. To navigate the choppy waters of inflation, we must first understand how it's measured. Economists rely on two primary indices: the Consumer Price Index, or CPI, and the Producer Price Index, or PPI. Think of these indices as barometers, gauging the pressure of rising prices in the economy. The CPI tracks the average change in prices paid by urban consumers for a basket of goods and services. This basket represents everyday expenses like food, housing, transportation, and healthcare. The CPI provides a glimpse into the rising cost of living for the average person. On the other hand, the PPI measures the average change in selling prices received by domestic producers for their output. It captures price movements at an earlier stage in the production process. Think of it as measuring inflation at the wholesale level before goods reach consumers. By monitoring these two vital indices, investors can get a comprehensive view of inflationary pressures in the economy. The CPI provides insights into the direct impact on consumers, while the PPI signals potential price increases that may trickle down the supply chain. Armed with this knowledge, investors can make more informed decisions about their portfolios. Inflation and interest rates are locked in a constant dance, each influencing the other like partners on a seesaw. When inflation rises, central banks typically raise interest rates to cool down the economy and bring inflation under control. Conversely, when inflation is low, central banks may lower interest rates to stimulate economic growth. This delicate balancing act has significant implications for investors. Rising interest rates increase borrowing costs for companies, potentially impacting their profitability and stock prices. Additionally, higher interest rates make fixed income investments like bonds more attractive, potentially diverting funds away from the stock market. For equity investors, this means a period of higher interest rates can be a double-edged sword. While some sectors like financials may benefit from higher lending rates, others, like consumer discretionary or real estate, may face headwinds due to decreased consumer spending and higher mortgage rates. Understanding this intricate relationship is crucial for investors to navigate the market effectively. By anticipating the potential impact of interest rate changes on different asset classes, investors can make strategic allocations to mitigate risks and optimize returns in an inflationary environment. Section 4. Nifty 50. A real-time perspective. Let's bring this discussion closer to home and examine the impact of inflation on India's benchmark index, the Nifty 50. The Nifty 50, comprising 50 of the largest and most actively traded stocks on the National Stock Exchange of India, provides a valuable, real-time perspective on how inflation affects the Indian stock market. During periods of high inflation in India, as witnessed in recent years, the Nifty 50 has shown volatility. Certain sectors, like consumer staples and healthcare, which are less sensitive to economic cycles, have generally outperformed. This is because demand for essential goods and services remains relatively stable even during inflationary periods. Conversely, sectors like automobiles and consumer durables, which are more discretionary in nature, have sometimes faced headwinds as rising input costs and reduced consumer spending have weighed on their performance. However, it's important to note that individual company performance within a sector can vary significantly based on factors like pricing power, cost management, and market share. Analyzing the Nifty 50's performance through the lens of inflation provides valuable insights for investors. By understanding how different sectors react to inflationary pressures, investors can make more informed decisions about sector allocation and stock selection. Section 5. Technical Analysis: Riding the Inflation Wave. Now, let's explore how technical analysis can help us identify inflation trends and make informed investment decisions. Technical analysis involves studying historical price and volume data to identify patterns and trends that may signal future price movements. One popular technical indicator used to gauge market sentiment and potential trend reversals is the Moving Average Convergence Divergence, or MACD. This momentum indicator helps identify shifts in the strength, direction, and duration of a trend. By analyzing the MACD in conjunction with inflation data, investors can potentially identify assets that are outperforming or underperforming during inflationary periods. Another useful tool is the Bollinger Bands, which consist of a center moving average and two standard deviation bands plotted above and below it. Bollinger Bands help visualize price volatility and potential overbought or oversold conditions. When price volatility increases during periods of high inflation, Bollinger Bands can help identify potential trading opportunities. Remember, technical analysis should not be used in isolation. It's most effective when combined with fundamental analysis, which we'll discuss in the next section to get a holistic view of the market. Section 6. Fundamental Fortitude: Unveiling Resilient Businesses. While technical analysis helps us navigate market sentiment, fundamental analysis focuses on evaluating the intrinsic value of a company. This involves analyzing a company's financial statements, management quality, competitive positioning, and industry dynamics to determine its long-term growth potential and resilience to inflation. During inflationary periods, companies with strong pricing power are better positioned to pass on rising input costs to consumers without significantly impacting demand. Look for companies with strong brand recognition, a loyal customer base, and a track record of maintaining healthy profit margins even during challenging economic conditions. Another crucial factor is a company's ability to manage its debt effectively. High levels of debt can become a burden during inflationary periods as interest rates rise, increasing borrowing costs and potentially impacting profitability. By diligently analyzing these fundamental factors, investors can identify companies with a strong economic moat, enabling them to weather inflationary storms and deliver sustainable returns over the long term. Remember, investing in fundamentally sound businesses is like building your portfolio on solid ground, ensuring stability and growth even amidst market turbulence. Section 7. Hedging your bets: Safeguarding your portfolio. While identifying inflation-resistant investments is crucial, hedging your portfolio against its erosive effects is equally important. Hedging involves strategically allocating a portion of your portfolio to assets that tend to perform well during inflationary periods, thus mitigating potential losses in your overall portfolio. Gold, often referred to as a safe haven asset, has historically served as a hedge against inflation. During times of economic uncertainty and rising prices, investors flock to gold as a store of value, driving up its price. Real estate is another asset class that tends to hold its value well during inflationary periods. As prices for goods and services rise, so do property values and rental income, potentially providing a hedge against inflation. Additionally, investors can consider inflation-protected securities, such as Treasury Inflation-Protected Securities, or TIPS, which offer returns linked to inflation. Remember, diversification is key to any sound investment strategy, and hedging against inflation is no exception.